The markets are asleep, but the money isn't. A silent wave of institutional capital, $50 billion strong, is just hours away from slamming into a market already drained of its most critical asset, silver. The vaults are empty, the shelves are bare, and tonight, the clock begins its final countdown. What happens? When unstoppable capital meets an unmovable shortage, what happens? Well, when the banks, the funds, and the factories all chase the same vanishing supply, and most of all, what happens in these next 48 hours that could change the financial game for a decade? Welcome to Currency Revelations, where we decode the signals before the system does. If you're new here, especially if you're over 50, don't just watch, subscribe. Because if you've seen a few market cycles in your lifetime, you already know the real storm always comes in silence. Tell us in the comments, where in the world are you watching from? And what does silver mean to your portfolio? The title says there are 48 hours left, but for anyone watching the financial world closely, time is even shorter. The markets appear calm, almost peaceful as the year begins. Screens show nothing unusual. Charts look frozen. Trading floors are silent. But beneath that calm surface, something far larger is forming. Something mechanical, something predictable, and something powerful enough to reshape the first quarter of the year. Every serious investor knows that markets do not always move because of news or emotion. Sometimes they move because of the calendar. And this is where the January effect begins. The January effect is not a myth. It is not a superstition. It is not a trend invented by traders on social media. It is a structural phenomenon rooted in how large institutions operate. He, she, or they may feel the market moves randomly, but the January effect is one of the few times when the movement is almost guaranteed. This pattern begins with the end of December, which is always a month of unusual behavior. Portfolio managers spend the last days of the year preparing their books for regulators, auditors, and the internal committees that judge their performance. They reduce risk. They lock in profits. They sell assets that performed well to show stability. They also sell losing positions for tax reasons. The pressure throughout December is mostly one-directional. It pushes capital out of the market. But the moment the calendar turns to January 1st, the rules shift. Overnight, a new fiscal year begins, the books reset, the restrictions ease, the pressure to sell disappears, and the pressure to buy takes over. Institutional investors, pension funds, insurance companies, sovereign wealth funds do not trade because of headlines or fear. They trade because they must follow fixed allocation models. These are strict formulas written into their internal systems. For example, 5% must be in commodities, 2% must be in precious metals, 10% must be in alternatives. If they end the year underallocated, they must fix it. Not next month, not next quarter. Now, the correction usually begins in the first week of January. This forced movement of money creates a predictable wave. The January effect is simply the moment when these massive funds must enter the market, regardless of the price, regardless of the news, and regardless of whether any retail investor is paying attention. This year, that wave is pointed at one asset, silver. Silver ended the previous year as one of the strongest performers. It outpaced bonds, outpaced many stocks, and outpaced most commodities. When the models updated on December 31st, they all signaled the same instruction: increase silver exposure. But this creates a problem, a large problem. The institutional world manages more than $50 trillion in capital. If even a tiny fraction, just 0.1%, needs to flow into silver, that equals 50 billion, and this is where the pressure builds. The global supply of silver is limited. Annual production is only around 800 million ounces. At recent prices, that is just over $56 billion worth of metal. This means the entire global production for a year is barely larger than the buy orders that may hit in a single week. When a large amount of capital chases a small amount of supply, the market does not correct slowly, it adjusts violently. This is why the January effect matters so deeply this year. It is not simply a pattern on a calendar. It is a structural collision between capital and scarcity. Traders watching the charts may not yet see what is coming. Retail investors may still believe they have time, but institutional systems do not wait, and capital does not sleep. As the futures market prepares to open, the price shown on screens appears calm, but that price represents thin trading. It does not represent real demand. It does not represent real volume. It does not represent the billions waiting to rebalance. This is the calm before the storm. In these 48 hours, expectations are building. Liquidity is preparing to surge. And every signal, from premiums in the physical market to drawdowns in vaults, shows the same pattern. The pressure is rising, and the real move has not yet begun. The January effect is not simply another yearly cycle. This time, it connects to something much larger: structural shortages, geopolitical tension, bond market stress, and institutional fear. The market is about to face a wave of capital that it may not be able to absorb at current prices. And when that happens, the price will not rise gradually. It will reprice suddenly. The countdown has already begun. At first glance, the number $50 billion might sound abstract, but in the world of commodities, it's not a number, it's a wrecking ball. Silver is not a tech stock. It is not a trillion-dollar market. It is a thin, shallow pool of liquidity, easy to disturb, almost impossible to contain when struck by force. And force is exactly what's coming. In boardrooms across New York, London, Frankfurt, and Singapore, portfolio managers aren't guessing. They're executing. They aren't chasing headlines. They're responding to models, risk models, mandate models, rebalancing models, all of which were reset at midnight on December 31st. These models, fueled by the top performance data of 2025, now demand a shift. The top performing hard asset, silver, sits at the top of the list. And capital must follow. Here lies the problem. The capital is enormous. The asset is not. Let's run the math. The global pension and endowment industry manages over $50 trillion in assets. Most of that capital is locked in stocks, bonds, and real estate. But with inflation proving to be more persistent than central banks predicted, and traditional 60-40 portfolios underperforming, many funds are turning to alternative assets for protection. If just 0.1% of this global institutional capital rotates into silver, that's $50 billion in demand. Now compare that to supply. The world produces around 800 million ounces of silver per year. At $71 an ounce, that's roughly $56 billion worth of global production for the entire year. But the January effect doesn't unfold over a year. It plays out in a week. If $50 billion in fresh capital attempts to enter a market that only produces $56 billion in value annually, the consequences are simple and absolute. The price must rise, not gradually, not evenly, instantly, because this is not just a liquidity mismatch, it's a mechanical bottleneck. Picture a commercial jet attempting to land on a private airstrip, too large for the runway, too fast to stop, no margin for error. That is what happens when massive institutional capital tries to enter a market that is both shallow and constrained by physical scarcity. And make no mistake, the silver market is constrained. Vault inventories are declining. Dealers are reporting shortages. Mines are not increasing output. And unlike digital assets or equities, silver cannot be printed, split, or diluted. The futures market, where price is officially discovered, operates on leverage, often as high as 100 to 1. This means that most silver traded on paper has no physical backing. When $50 billion in real, settled capital hits this market, the thin layer of futures contracts will be peeled away, exposing the absence of actual supply. This is when the squeeze begins. The term squeeze is often misunderstood. In retail investing, it suggests excitement or chaos. But in institutional finance, a squeeze is a structural failure. It's when the market's supply mechanism breaks under pressure. And when that happens, the price stops being negotiated. It starts being dictated. This is why timing matters. The futures market reopens tonight. The major funds, many of which have pre-programmed trade windows, will execute their January allocations within the first 5 trading sessions. And they will not wait for perfect conditions. If their mandate is to allocate 2% to commodities, and silver is the highest performing asset, they must buy. There is no negotiation, no delay, no strategy to buy the dip. This is how mechanical trading differs from discretionary investing. And the machines follow the rules, blindly but efficiently. And that efficiency can trigger market chaos. The real story is not whether silver will rise. It is how fast the price will have to rise to absorb the incoming capital. If silver remains at $71, $50 billion can absorb most of the world's annual production. But it won't remain at $71. If silver hits $140, that same capital only buys half the global supply. At $280, it buys a quarter. Price, in this case, is not speculation. It's rationing. It's the only mechanism the market has left to deal with a demand spike this large. And that rationing mechanism is about to be stress tested. The countdown continues, and the first trades will tell the story. They don't speak to each other. They don't meet in secret rooms. They don't coordinate calls across time zones. And yet, somehow, this week, they're all doing the same thing. The world's pension funds, hedge funds, investment banks, and industrial giants, separate entities with separate goals, are suddenly moving like a single organism. They're all reaching for the same asset at the same time, for very different reasons. The institutions are first. These are not retail traders reacting to news headlines or chasing short-term price action. These are capital allocators, managing hundreds of billions. Their trading windows open this week. Their performance metrics reset at midnight on December 31st. Their orders are not emotional, they are mechanical. And the models they follow, black box algorithms, risk parity strategies, and multi-asset optimizers, are all flashing the same word: silver. Silver ended 2025 as the best performing hard asset on the board. Bonds failed. Stocks were volatile. Real estate lagged. Silver, on the other hand, held its ground and moved higher. That single signal is enough to trigger billions in fresh inflows. Institutions are not asking if silver is undervalued. They are not asking if silver is in short supply. They are only asking one question: what does the model say to buy? Next come the banks. Only days ago, these same institutions were the ones pressing prices lower. They were the largest net sellers of silver in the final week of December. Not because they were bearish, not because they believed silver was headed lower, but because they were managing year-end risk exposure. Regulators used December 31st to assess balance sheet health. The banks knew this. They offloaded silver to reduce volatility on their books. But that window is now closed. The regulatory snapshot is complete. Risk scores have been logged, and the banks are free to re-enter the market, not as sellers, but as buyers. Strategic buyers, opportunistic buyers. Banks do not wait, they front run. If a pension fund is going to buy silver on Friday, a bank will buy silver on Thursday night, then sell it back to the fund at a higher price. This is not illegal. It's not unethical. It's simply how the market works. Large players move early, they trade the flow, then comes industry. While the traders look at charts, factories look at contracts. January is known as procurement season. It's the time when industrial users, electronics manufacturers, solar panel producers, automotive firms lock in their yearly supply of critical metals. Silver is on that list. But this year, the conversations in procurement meetings are very different. Refiners are warning of shortages, miners are holding back inventory, recyclers are falling behind. The message is clear: supply will not meet demand. For companies like Tesla, Samsung, and First Solar, this is not a minor concern. This is existential. If silver cannot be secured, production halts. Factories shut down, orders are canceled. CEOs are not waiting for market dips. They are paying premiums in private deals. Some are bypassing public markets entirely, calling vault operators in Zurich and London and wiring cash directly. This industrial panic does not show up in headlines. It does not appear on futures exchanges, but it quietly removes inventory from circulation. It tightens supply behind the scenes. And when the futures market opens again, traders are shocked to find that the inventory they thought was available is already gone. This convergence of buying from institutions, from banks, from industry is extremely rare. Each actor has a different motive. One is responding to models. One is chasing flow. One is securing survival. But the result is the same: pressure on a market that cannot absorb it. Meanwhile, retail investors are largely absent. Many are unaware. Many are still watching prices on screens that reflect holiday volume. But the professional class is already in motion. This is how revaluations begin, not with retail euphoria, not with headlines, but with quiet decisions made in back offices, across spreadsheets and boardrooms. When all the capital decides to move at once, no matter the reason, the market has no choice but to adjust, not slowly, not carefully, but instantly. The question now is not who is buying. We know who. The question is who is selling. And that silence may be the loudest signal of all. They thought it was just about silver, a simple market imbalance, a tight supply chain, an asset and temporary shortage. But what the institutions are walking into, what the banks are front-running, what the industrial buyers are reacting to, is not just a commodity squeeze. It's the early tremor of a much larger quake. The pressure beneath the surface is not only from demand, it's from debt. The United States enters 2026 with $36 trillion in national obligations and over $1 trillion in annual interest payments. That number now exceeds both the U.S. defense budget and the Medicare system. It is no longer sustainable, and markets know it. Next month, Washington faces another debt ceiling crisis. It's happened before: arguments in Congress, threats of default, last-minute deals. But this time, the numbers are different. The interest bill has ballooned. The bond market is no longer patient. And credit rating agencies, Fitch, Moody's, S&P, are circling. In the past, silver moved on supply. This year, it may move on currency risk. When confidence in sovereign debt breaks down, money begins to search for alternatives. That money does not run to stocks. It does not flee to corporate bonds. It runs to assets with no counterparty risk, assets that cannot default, that cannot be printed, gold, and increasingly silver, because silver has two faces. It is an industrial input, and it is monetary metal. In times of calm, it acts like the first. In times of crisis, it becomes the second. Right now, both faces are active. The macro backdrop is worsening. Bond yields are rising, not because the economy is booming, but because investors are demanding higher compensation to lend to governments they no longer fully trust. These are the bond vigilantes, large funds that punish fiscal irresponsibility by selling treasuries. When bonds sell off, yields spike, and when yields spike, banks start to break. It happened before, in 2023, when Silicon Valley Bank collapsed under the weight of underwater bond holdings. That was a regional signal. This could be global. The Federal Reserve is trapped. If it raises rates to defend the dollar, it increases the risk of a banking collapse. If it cuts rates to save the banks, it unleashes another wave of inflation. Either way, the trust in the system erodes. and silver, once forgotten, becomes visible. Already private deals are reflecting this shift. Industrial buyers are paying $80 per ounce, while the public screen still shows $71. This is not a market reacting to hype. It is a market reacting to two sets of prices, one for paper, one for reality. This divergence is no longer technical. It is philosophical. It is about trust. And as trust breaks, something else enters the frame: the East. While Western media focuses on inflation targets and bond yields, the BRICS nations, Brazil, Russia, India, China, South Africa, are moving. They are forming trade alliances, drafting new settlement mechanisms, preparing to challenge the dollar's dominance. And they are not doing it with paper promises. They are doing it with commodities: gold, oil, rare earths, and silver. If silver is added to any form of BRICS-backed monetary unit, even in part, it immediately jumps from industrial metal to monetary reserve. The valuation model changes. Its price ceiling disappears. This is not a theory. It is a shift already in motion. China has already locked down silver exports. Their internal premiums are $5 above New York prices. Their buyers are hoarding physical metal. And Western vaults are being drained quietly, steadily, relentlessly. Silver is being reclassified, not officially, not by law, but by use. When factories need it to stay open, when banks buy it ahead of clients, when governments can no longer issue risk-free debt, silver stops behaving like a commodity. It starts behaving like money. And money, once chosen by the market, does not ask permission. It does not wait for headlines. It revalues suddenly. The $50 billion demand spike was the trigger, but the real story is the fuse it lit: debt, inflation, structural shortage, monetary distrust. These are not temporary pressures. They are long-term forces that compound with time. And when all of them align at once, there is no forecast, only fallout. This is not the end of a cycle. It is the beginning of a shift. And that shift has already started.